Something is happening in Bitcoin right now that most people in this space are not fully connecting. And I don't mean the price, I don't mean the chart patterns, I don't mean whatever's trending on crypto Twitter at midnight. I mean something deeper, something structural, something that tends to appear before the big moves happen, not after. Over the past 6 weeks, more than $7 billion has quietly left United States spot Bitcoin ETFs across 2 separate outflow streaks. Back to back. Record-breaking. The largest single-week withdrawal event in the entire history of these products happened in early June 2026, when over $3.4 billion exited in a single week alone. Let that number sit for a second. $3.4 billion in 1 week. That is not retail panic. That is not small traders getting scared and hitting sell. That kind of capital movement requires coordination, infrastructure, and a reason. A real reason. And that is exactly what we're going to talk about today. Because once you understand the 3 clues hidden inside this exodus, the picture that emerges is not just about Bitcoin. It's about the entire financial environment we are operating inside right now, and what comes next for anyone holding risk assets. Stay with me until around minute 14. Because what I'm going to show you in that section is the signal most investors are completely ignoring. And it may be the most important piece of data in crypto right now. Quick note before we go any further. Nothing in this video is financial advice. This is analysis and education only. Always do your own research and speak to a professional before making any financial decisions. Now let's get into it. To understand what's happening, we first need to go back to when this all started. January 2024. Spot Bitcoin ETFs launch in the United States. The SEC finally gives the green light after years of rejection. And within weeks, capital begins flowing in at a rate nobody had ever seen from a newly launched financial product. BlackRock's iShares Bitcoin Trust, known as iBit, becomes the fastest ETF in history to reach $10 billion in assets. Fidelity's fund follows, more products launch. The narrative becomes almost self-reinforcing. Every day, media outlets report new inflow records. Every day, investors feel more confident. Every day, the story sounds the same. Institutional money is here, and it's not leaving. By the time we reach the peak of that inflow cycle, cumulative flows into spot Bitcoin ETFs had surpassed $58 billion. That number is extraordinary. That number represents genuine, structural, institutional commitment to Bitcoin as an asset class. But here's where the story starts to break down. Because in 2026, something changed, quietly at first, then louder, then impossible to ignore. The flows reversed, not gradually, not slowly. In 2 violent streaks spread across May and June, those products collectively hemorrhaged $7.2 billion. And for the first time since these products launched, year-to-date cumulative flows turned negative. Bloomberg ETF analyst Eric Balchunas confirmed it. The milestone was real. Now here's the question most people are not asking. They're asking whether Bitcoin's price will recover. They're asking whether the bottom is in. They're asking whether now is a good time to buy the dip. But the better question, the more important question, is this. Why did $7 billion leave? What did those institutions know or see or believe that made them move that capital out the door at that speed? Because when money that size moves, it doesn't move on accident, and it doesn't move on emotion. It moves on a reason. Comment below right now, morning, afternoon, or night for you. I'm genuinely curious where in the world this community is watching from. That reason is what we're chasing today, and it comes in 3 pieces. Clue 1, the footprints before the earthquake. Here's the first thing you need to understand about institutional capital. It doesn't think the way you think. When retail investors look at Bitcoin, they tend to think in terms of momentum. If the price is going up, it feels good to buy. If it's going down, it feels bad. Decisions get made based on what the chart looks like in the last 24 hours. Institutional capital doesn't work that way. Large asset managers, pension funds, hedge funds, and wealth management desks think in terms of risk-adjusted returns, portfolio allocation targets, liquidity windows, correlation to other holdings, and macro exposure. They have committees, they have risk frameworks, they have models. And when those models start flashing yellow, not red, not yet, but yellow, capital starts moving, quietly, systematically, often before any headline tells the rest of the world something has changed. ETF flows are one of the clearest windows we have into that institutional thinking. Because ETF flows are transparent, they're reported daily, They show you exactly how much capital is moving in or out of these vehicles. And when you track them carefully, they often reveal sentiment shifts before the price confirms them. Think of it like footprints. You may not be able to see the animal yet. You may not know exactly where it's going, but you can see something large move through this space. And those footprints are telling you something moved, fast, with purpose, and in the same direction. Right now, those footprints are pointing toward caution. Not panic, not collapse, not the end of Bitcoin, just caution. And IBIT, the largest, most liquid Bitcoin ETF on the planet, with roughly $67 billion in assets as of earlier this year, has become the epicenter of that caution. Data from Farsight investors showed that during the week of June 22nd through 26th, 2026, IBIT alone accounted for nearly 73% of all weekly Bitcoin ETF outflows. That's one fund, one set of institutional redemptions, driving nearly 3/4 of the week's exit. Now, here's the part nobody is paying attention to. An outflow from a fund like IBIT is not just a sentiment signal. It's a transmission risk. Because when large institutions redeem shares, the mechanics of that redemption can create real selling pressure on Bitcoin in the spot market. The ETF has to unwind. Bitcoin gets sold, supply hits the market. And if that keeps happening week after week, the demand story that held the price up starts to weaken structurally, not just narratively. But here's what makes this even more interesting. The same period showing these outflows also showed something else. Exchange data suggested Bitcoin was actually moving off centralized platforms into cold storage. Net exchange outflows were happening simultaneously, meaning some holders were pulling Bitcoin off the market entirely, treating it as a long-term store of value rather than something to trade. That creates a very unusual picture. Institutional sellers on one side, long-term accumulators on the other. Hit like, if this is starting to make sense, because this tension between short-term institutional rotation and long-term holder conviction is exactly the kind of setup that precedes significant price movement in either direction. The real question is which force wins. And Clue 2 tells us a lot about that answer. To understand what's actually driving these institutional outflows, we need to leave Bitcoin entirely for a moment. We need to talk about money itself. Specifically, how much of it is flowing through the global financial system right now, and whether that flow is accelerating or tightening. Clue 2, the invisible hand of liquidity. Here's something that experienced macro investors understand deeply, but most crypto participants learn the hard way. Bitcoin doesn't exist in a bubble. Neither do stocks, neither does gold, neither does real estate. Every single risk asset on the planet shares one fundamental dependency, and that dependency is liquidity, the availability and cost of money moving through the financial system. When liquidity expands, when money is cheap, when central banks are accommodative, when credit flows freely, risk assets tend to perform. Investors feel comfortable taking on exposure. Capital moves into higher risk, higher reward spaces. Bitcoin thrives in that environment. When liquidity contracts, when money gets expensive, when central banks tighten, when credit becomes harder to access, risk assets face headwinds. Investors reduce exposure. Capital retreats towards safer, yield-generating alternatives. Bitcoin struggles in that environment. And right now, we are in one of the most complex liquidity environments this market has navigated in years. Here's the reality as of late June 2026. The Federal Reserve has held interest rates in the range of 3.5 to 3.75%. Prediction markets have been pricing in a roughly 50-50 chance of at least one rate hike before the end of the year. Not a cut, a hike. That is a dramatic reversal from where market expectations were at the start of 2026, when multiple rate cuts were broadly anticipated. Consumer Price Index data released in June showed year-over-year inflation re-accelerating to 4.2%. Core PCE, the Fed's preferred inflation measure, came in at 3.3% as of the April reading. Real disposable personal income fell month over month. The personal saving rate sat at 2.6%. None of these numbers are catastrophic in isolation, but together they paint a picture of an economy that is running warmer than the Fed would like, with consumers under pressure from persistent price increases and a central bank that cannot easily ease without risking a second inflation wave. Now here is exactly why this matters for Bitcoin. When the Fed holds rates high, or worse, signals potential hikes, the opportunity cost of holding a non-yielding asset like Bitcoin goes up. Investors can park capital in treasury bonds and earn real risk-free returns. That changes the math for institutional allocators fundamentally. Why hold Bitcoin at elevated volatility when you can hold short duration treasuries at 3.5% yield with no downside risk? That trade-off has been playing out in flows all year, and it's one of the clearest explanations for why institutional money has been reducing its Bitcoin ETF exposure. But it goes deeper than just interest rates. The Federal Reserve's QT, quantitative tightening, program is still running. The balance sheet is still shrinking. That means the total amount of money in the system is being gradually drained. It's not dramatic, it's not sudden, but it's persistent. And persistent liquidity drainage tends to show up first in the most speculative, highest beta assets. Here's an important question for you right now, and I genuinely want to see this in the comments. Are you positioned for this environment, or are you still operating with a mental model built for a world of cheap money that may not exist anymore? Because this is where smart money is already moving. They're not running from Bitcoin forever. They're managing exposure to an asset that becomes harder to hold when the macro environment is actively working against it. Which brings us to the third clue, and this one is different. This one isn't about what's already happened, it's about what's coming next, and what it will tell us about Bitcoin's future. Clue 3, the demand test that will define the next move. Here's the question that almost no one is asking right now. If ETF demand weakens, if the institutional bid that drove so much of Bitcoin's narrative over the past 2 years becomes a headwind instead of a tailwind, who fills the gap? Think about what the ETF story actually did for Bitcoin. It didn't just bring capital in, it brought credibility. It brought a new class of buyer who had never held Bitcoin before. It brought Bitcoin into brokerage accounts and retirement portfolios and wealth management models across the country. It legitimized the asset in the eyes of pension fund committees and compliance departments that would never have touched it before. And it created a feedback loop. More institutional buying meant more headlines meant more retail interest meant more ETF demand. The cycle reinforced itself for months. Now test what happens when that cycle runs in reverse. Outflows generate negative headlines. Negative headlines reduce retail enthusiasm. Reduced retail enthusiasm reduces ETF demand, which generates more outflows, which generates more negative headlines. We're not fully in that reverse loop yet. But we're close enough to the edge of it that the next few weeks matter enormously. Now here's what makes this interesting, because it's not all dark. There are countervailing forces worth understanding. Corporate treasury buying has not stopped. Companies following the strategy pioneered by MicroStrategy, now rebranded simply as Strategy, continue to accumulate. The model of using Bitcoin as a corporate treasury reserve asset has spread to other companies around the world. That's a demand source that operates independently of ETF mechanics. International demand is a wild card. The ETF story is primarily a US story, but Bitcoin is a global asset, and regulatory clarity in other jurisdictions, adoption by sovereign wealth funds outside the US, and cross-border capital flows can introduce demand that doesn't show up in Farsight's daily ETF data. On-chain data suggests long-term holders are not selling. Exchange outflows indicate that a meaningful cohort of Bitcoin holders is pulling coins off the market and into cold storage, treating current prices not as an exit opportunity, but as an accumulation window. And there's a regulatory tailwind quietly developing. The Clarity Act, a crypto market structure bill, advanced through the Senate Banking Committee in May 2026. Institutional investors hate legal ambiguity more than they hate volatility. Clearer rules tend to open doors that compliance teams kept shut. That's a structural positive for long-term demand. But here's the honest truth. None of those countervailing forces are large enough right now to fully replace what ETF inflows were providing at their peak. The test Bitcoin faces over the coming weeks is whether demand is broad and deep enough to hold without the ETF tailwind, or whether the market was more dependent on that single source of institutional demand than most participants were willing to admit. What would you do if this actually plays out? I'm serious. If ETF flows stay negative through summer and Bitcoin tests that $60,000 to $66,000 support zone hard, what's your move? What's your plan? Drop it in the comments. I read every single one. Because here's what I know. The people in this community who think clearly about scenarios in advance are the ones who don't panic when the scenario unfolds. And they're the ones who find opportunity where everyone else finds fear. Let's pull this together now, because individually, each piece of this story is interesting. But connected, they tell you something much more important. Clue 1 showed you that institutional capital is pulling back from Bitcoin ETFs at a historic pace, and that the mechanics of that pullback carry real transmission risk into the spot market. Clue 2 showed you that this is not primarily a Bitcoin story. It's a macro story. Persistent inflation, rates on hold at elevated levels, the possibility of hikes, a Fed that cannot ease without risking a second wave. These forces are the invisible hand reshaping institutional risk appetite across every asset class, including crypto. Clue 3 showed you that Bitcoin now faces its most important demand test since ETFs launched. And the outcome of that test over the next several weeks will reveal whether the bullish structural thesis is intact or whether it was more fragile than the narrative suggested. Together, these 3 clues create an environment defined by one word: uncertainty. And here's what most people get wrong about uncertainty. They treat it as a reason to do nothing, to wait, to watch, to stay paralyzed until the picture becomes clear. But uncertainty is where the biggest opportunities live, because uncertainty is also where the majority of investors make the most emotional, least rational decisions. The crowd is watching the price. You've been watching the flows, the macro, and the demand structure. That's a different vantage point. And different vantage points are where edges come from. Subscribe and turn on notifications if you want to keep building that edge. Because what comes next in this market is going to move fast, and the people with context are going to see it before the people who are just watching candles. So let's land this. $7.2 billion has left spot Bitcoin ETFs across 2 record-breaking outflow streaks. Year-to-date flows are negative for the first time in the history of these products. IBIT, the dominant vehicle, is driving the lion's share of that exit. Macro conditions are working against risk assets. The Fed isn't cutting, inflation isn't cooperating, and Bitcoin's demand story is about to face its most important test since January 2024. This is not a prediction of collapse. This is not a guarantee of a crash, but this is also not the time to look away. The signals are moving, and they're moving in ways that matter. So here's my question for you, and I want a real answer in the comments. Which of these 3 clues concerns you the most right now? Is it the ETF outflow mechanics and the transmission risk they carry into the spot market? Is it the macro environment, the Fed, inflation, the cost of money, the liquidity compression that's quietly squeezing risk assets? Or is it the demand question? The possibility that Bitcoin's bull case was more dependent on ETF inflows than anyone wanted to admit. Tell me where your head is. I read every comment. And one more thing. If you've been watching this channel for a while and today's breakdown finally made the pieces click together, do me a favor and drop the word signal in the comments. I'm tracking which topics land hardest with this community, and that'll be my signal to go even deeper on this thread. Share this video with one person in your life who holds Bitcoin and has no idea this is happening. Not to scare them, to prepare them. Because the best thing you can do in an uncertain market is understand it clearly before the crowd catches up to where you already are. See you in the next one.